All right. Hello, everybody, and welcome to another Pepperstone live event here over on YouTube. It's great to have everyone here today, and I hope you're excited as I am to go into some of the topics. And of course, one of those topics is one of my favorites, which is supply and demand theory. Basically, when it got first into trading, day trading, scalping, any of those types of things, supply and demand was a topic that was almost just kind of like a little new. And then things started to get a little bit more well known about positioning. And today we'll talk about two really important learning lessons that I think will help all of us to better understand the market. So if you enjoy this type of thing, make sure you let Pepperstone know, give it a thumbs up, and of course, subscribe to the channel down below. We're well over 100,000 now, which is awesome. So let's get into what we're learning today. And of course, today's topic is day trading strategies, maximizing profits using supply and demand. The learning outcomes will be pretty simple. Basically, we want to understand a little bit of a solid grip on grasp on why supply and demand areas actually form, how to use them, and how we can potentially use them for profit potential. And then by the end of the session, we'll be looking at how to identify key supply and demand zones and using some tips and tricks towards, really analyzing markets a little bit better. How do we find these things? Because it's not just understanding theory, it's also understanding how we're better going to actually find and potentially place orders. And then, of course, we'll get a bit of a toolkit with some Q&A at the end, and make sure to ask any questions in the chat as we're going along here. And at the same time as well, we would love to see your feedback as well in the comments down below. Okay, so without further ado, if everyone can hear me, which I believe you all can, it looks like we're there. Okay, fantastic. We'll get into the first thing. So most traders ask me the question of how do we use supply demand zones to better find day trading opportunities? Well, here's a little bit of a hack that maybe Wall Street doesn't want you to know about when it comes to better understanding the markets. We'll be covering in today's video how do supply and demand zones actually form, why it's important for us to understand order positioning for day trading and scalping, and when do supply and demand zones tend to actually give us opportunities. Well, first up, I want to say one thing, and that is that supply and demand zones can be used as both entry areas and exit zones. That's what makes them so fantastic and what really differentiates supply and demand from other strategies that are used. You know, the other great thing about it, it's about understanding where orders are placed in the market. So if you ever ask yourself a question, how does price action actually form? Well, of course, there are buyers and there are sellers. The most important thing about this, though, is what is the dynamic? Where are the buyers and sellers winning or losing? When we get an upward trend, what's happening? The buyers are outstripping the sellers. In essence, the demand is strong. If you ever think about any market in Economics 101, we all know this. Whenever, let's say, everybody wants a house and it's an auction, if you have that, basically everybody bids on it. Demand is strong, the price goes up. It's the same thing in stocks. It's the same thing in currencies. It's the same thing in pretty much everything in life. It is a differential between the buyers and the sellers. So I always assume that in this video in particular, we already understand the basics of supply and demand. But what we want to now know is how do big Wall Street players actually position into markets? Well, remember, they don't have stop losses and they don't have take profits like you and I. Instead, what they do is they always hold usually some form of position, and they scale up that position and scale that position back over time. So what this means is as markets come down to a price, let's say somebody decides they want to buy a big position. Here we have the Australian US dollar, though this could be a stock or anything else. As it comes down to a level, they decide that they are interested in purchasing a position, and they start to buy it at the price of 72 cents. That then gives an initial potential tick up, but maybe the selling pressure is too much. And as it comes down to 71 cents and 70 cents, they get more excited about purchasing this market. Now, why this is important is because we're more interested in finding out where positions that have led to a large change in market conditions actually occurs. Think of it as actually with supply and demand theory, what you're more interested in is not so much the trend itself, but you're interested in where are the orders. And this is a question we always ask ourselves. So you're going to start thinking about looking at sideways price action, looking at price action where the markets are basically trapped within two areas as one of the key components of what you're actually going to be paying attention to in the future. And this could help us specifically as day traders and, of course, scalpers as well. So as the market comes down, they decide they like to buy these prices, and you'll see things represented on these charts. Think about the storyline. What if you saw a wick candle such as this, a bullish hammer that happens as the market come down to this level? Well, that would show you that the markets are potentially excited about buying that price, and someone's really like to buy 70 cents and 71 cents, and they're starting to get a little bit excited, and more people are understanding that. A good rule of thumb whenever you're looking for supply and demand and you're trying to better understand it is to use what I call the 1+1, 2+2 method. So, what that means is you have one touch to one side, like this 1+1, and then you have the second touch to each side. And when that occurs, what basically you're looking at is you're looking at a market that has become range bound. Now, in essence, people call these channeling markets or range bound markets, and it's a point where price is stabilized. Think of this as kind of a harmony or some kind of equilibrium between the buyers and the sellers. Instead of one outstripping the other, where we've got, let's say, demand outstripping supply or supply outstripping demand, we have a harmony. And this harmony means that somebody is placing large orders into the market. And once we start to think of markets that way, we can say, well, what we're actually interested in doing or why channel patterns potentially work. And you often have seen probably channels look like this. You buy, you place a stop loss below, you take what we call the distance of the channel or the range, and then you extrapolate that out. Basically, that is the area where usually market participants are always going with this idea of, oh, what's a self-fulfilling prophecy? Actually, what's happened here is there has been a change in the demand or the supply. Basically, we have broken to the upside. Therefore, demand is greater than supply. And it's this interaction when it breaks out that we want to start to consider when we're trading in day trading and investing. If we think about what we're going to be doing a lot more on charts, therefore, is you're going to start looking at the zones more than just a key level. When you first learn about technical analysis of any type, you'll always come into technical analysis and you'll say, well, these are resistances and these are supports. And you'll learn generally the difference between support and resistance more so than anything else. And there's nothing wrong with support and resistance. It's a great way of understanding markets. But if you want to take it to the level of supply and demand, what that will then foretell you is it will say, well, we should be paying attention a little bit to the reactions. Over here on the left-hand side, and I'll just quickly get rid of my face here for a second. And what we'll see is we've got like a little block. Basically, we have some area where the market's kind of gone 1, 1, 2, 2 on the smaller timeframes. It's then broken to the upside. It's that break to the upside we want to understand. This therefore becomes a portion of an area where orders have been placed. Those orders have led to a massive uptick. And if the markets come back down to that level in the future, there may be buyers there. And that's what we're going to start to use as day traders and as scalpers. So when do we use supply and demand? What pairs do we use it on? First up, supply and demand always needs to generally be used when it comes to the key major pairs. We're going to be looking at big liquidity events. Remember, we talk about supply and demand as position entry by the biggest players in the street. Therefore, because it's the biggest players in the street that are entering, we need a lot of liquidity and we need to understand that they've got a large book. So things like gold, US dollar majors, major crosses, indices, these are great places to start your supply and demand theory and also to start breaking down markets a little bit more effectively. Another thing that a lot of people don't understand and think about is when do these supply and demand zones tend to form? Well, actually, it's a really great question. Often we see a lot lower trading volume during what we call the Asian session for many pairs. What tends to form there? Well, we actually usually get sideways or supply and demand style markets or demand style structure forming in the markets. And the reason why this is because price is not pushing in either direction. Another easy way to think about it is that what tends to break a channeling or range bound market? And the simple answer is news and news events. So often what will happen is you'll get a news event that will trigger, let's say, some form of move. If it moves to the downside, therefore this would be supply. And that then would trigger potential sell-off to what we call the next level of equilibrium, or in this case, the next level of supply and demand. So it's kind of like basically working out that markets will become range bound. They will often break out in session opens when you get that increased liquidity. And they'll also break out during news events. And it's just this common sense that I think a lot of people don't necessarily use in markets. And it's one of those advanced techniques that you can use as a supply and demand trader. You can start to understand that markets will build. And when you think about it, of course, they're going to break out during news events. And it might seem like common sense, but a lot of people don't really necessarily understand that or think about it when it comes down to understand, well, really thinking about structure a little bit more. So one of the key things from today's video here so far has been the 1-1 and 2-2 theory concept. Next time you start looking at structure and you're thinking, how do I find supply and demand? Think about the first touch to each side and then the second touch to each side. And that will really help to differentiate you from many others when it comes to finding these key zones. Another question that we always get asked by everybody out there is, how do we unlock the power of supply and demand? How do we actually use this in the charts? And more importantly, what does it even look like in the charts? What does supply and demand look like in the charts? What's a good copy of one? Well, today we'll talk about using trend with supply and demand concepts. And of course, we'll be looking at what a good supply zone may look like and some of the ways we can trade it. And what does a good demand zone look like? So first up, recognizing trends and price action. Now, most of us would already know that recognizing trends and trend being our friend is a super key thing. Effectively, we need to understand that when we have a series of higher peaks and higher troughs, we're in an upwards trend. If we have a series of lower troughs and lower peaks, we're in a downwards trend. And I don't think that's rocket science. Of course, we always understand this and everybody pays attention to it. But what if we were able to use supply and demand concepts over the top of basic trends, understanding that when we have a series of lower lows and lower highs, we could use potentially a mixture? Well, what we do is we start to apply multifaceted approaches. Now, I'm always a big believer that whenever we're considering using any new system, whether it's supply and demand or it's support and resistance or it's an indicator of any kind, you want to use them together with a word like confluence. So we need to find quite a few reasons before we place a trade. It's very unlikely that any one thing in trading or investing will be successful. It's about building the evidence in your favor. And I'm always liking to use around 4 to even 6 different reasons to be in a trade. Now, if you understand the concepts of support and resistance already, you might be familiar with the idea of role reversal. And role reversal is where previous resistance becomes support after a breakout. In essence, what's happened is the market has got more demand in it. Effectively, demand is outstripping supply and the price is going up. Then what happens is the price turns around and it comes back down and it hits a previous level of resistance. But what a lot of people don't understand is this can be a place where we get overlap between supply and demand and role reversal style concepts. Take this example, for instance. Here we have a classic resistance: 1, 2, 3, and 4 resistance hits. Then the market comes up, and you'll actually notice here it sits here for a little while, and it has a couple of bars on whatever time frame this is, which in this case is a 4-hour, and then it makes a break to the upside. Now, in essence, what this little area in here actually is a demand zone. Now, why do we know it's a demand zone? Well, first up, we know it's a demand zone because the market ends up breaking out to the upside. The thing I love about supply and demand concepts is we're often using it after we've seen the reaction. So we're not making a prediction in markets. And instead, what we're doing is we're saying, we see what's happened here. The market has positioned, the market has broken up, and now we can be patient to wait for it to come back down. I often say patience, react, don't predict. And I think that's something that a lot of day traders and scalpers can take and really start to apply. And it's about that deeper understanding of market conditions. So in this case, we break out, and most people would be looking at this resistance as a period of support, and therefore the market may bounce off it. But it's much more than that. It's also this area here. Something has entered into this market around this zone where there was a seller. There were sellers before. Remember, 1, 2, 3, and 4 times there were sellers. Then there were sellers again. And those sellers were getting squeezed effectively as the market comes up. Now, what a squeeze is effectively they've got a sold position here. And they may not have a stop loss, but they may be leveraged, who knows? And they will be getting pressured as the market comes back up into this zone. Now, that pressure can lead to these big candles where basically they're having to get taken back out. Remember, if you have a sell position and you're forced to close that sell position, what does the sell position become? It becomes a buy. So this is the kind of thing that often happens around here. Now, once you see a reaction like that, remember, it's not just understanding that when it breaks to the upside, this is therefore demand. It's also about understanding that this candle here is quite large. So what does that mean? There was a big order and quite a lot of pressure was put on this market. So remember to start thinking about the storyline with your supply and demand theory. And in this case, we have a great storyline. Big candle, market goes up, market comes back down, previous resistances become support, the theory of role reversal. But at the same time, it also goes into where we already know some large positions were, because we can see that sideways action. That is a 1-1-2-2 on the smaller timeframes. So therefore, as it comes back into that zone, see how it reacts. And what's the reaction of this? Wicks. So just some key little points there. A lot to dissect in this market, and a deeper understanding is what we're looking for whenever we're considering any theory, really, when it comes to this stuff. So here's some supply and zone and supply zones in action. And basically, we have quite a few key levels here. Basically, this is a downward trend. Now, I've got a 20 moving average on this, which is sitting on the 4-hour time frame. You might say, well, I'm as a day trader, I want to trade the 5-minute, the 15-minute, the 1-hour chart. That's totally fine. There's no problem with that. But I always suggest let's look at the higher timeframes first to understand zones that we might want to target on the smaller timeframes. And what you've noticed, if I've got some arrows here, 3 arrows on the way down. Now, these are all, of course, reaction points. So, of course, patience, react, don't predict. So what does that mean? Well, over here on the left-hand side, we have a market that's sold off, and it's come down to this level, and it's created a 1-1-2-2 on the smaller timeframes. It's then sold off. Again, what's the trend? The trend is down. As the market rallies back up, you'll notice that it comes back into this key level here, and it might look at first instance that this support is becoming resistance, but it's much more than that. We know that there were orders placed here that led to an aggressive sell-off. So therefore, if the market comes back into this zone, we're looking for potential sells. And this is what we call a drop, base, drop. What is it? Drop. There's the base, drop. Okay. And it's a pretty common concept in supply and demand theory. And it's a really good one for you to be able to apply to any higher time frame and then go into the smaller time frames. Then we get some other action down a little bit lower, and you can see the market comes down, it builds a position, and it probably creates a 1-1-2-2 on the smaller time frames, and then sells off aggressively, 2-3 large candles on the way downside. And it comes back, and you can see it hovers around this area. What would this area give us as a box? It would give us a zone where we could become bearish or look for sells over that period of time. So instead of somebody going, oh, it's a good place to sell here, well, why is it a good place to sell here? Maybe it's not. There's not a good supply demand zone strategy there. What we're interested in knowing is, where were the last orders placed that were large? What happened? Well, we now have that evidence. If the market comes back into this zone, is there a chance that we might see sellers? If the answer is yes, then it could be something that you could then say, oh, this is a good zone for me as a day trader and a scalper, and I could apply that to the smaller timeframes. And you can see there's another one down here, and I've selected here what we call a doji candle. And when you think about it, a doji candle is basically some kind of channeling market on the smaller timeframes. Why do you know that? Because a doji is effectively the open and the close at the same level, and of course a high and a low. So in essence, it's probably doing this on the small time frame. See how markets are fractal, they work this kind of way. So there's some good examples of supply zones. In terms of demand zones, well, it's the same type of thing. We're just really looking for probably some kind of trend breakout. Down here we have a series of lower lows and lower highs, and then all of a sudden we get a higher high. Oh, the trend may have changed. Now, again, I'm not going to make any predictions at that point, neither maybe should you. But what you will see here is it builds an area, builds pressure. Now, what did that look like? It looks like that role reversal signal from before. We actually have a 1 and a 2 here, and we have a build of a zone before it breaks out. And look at these candles. Boom, 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 boom. Massive, big size candles. That's a key point, because basically that's telling us there's a lot of strength in this market. and the market's leading towards maybe putting the squeeze on everybody as well. So if it comes back down to this level of demand, could that be key? Well, turns out it was. And of course, what you're looking for is a reaction off the point. Just like as we go up here and we come back down in the future, guess what? We get a strong reaction. So when you're thinking about supply and demand zones in the future, think about the storyline again as a big story here. Think about how to create better supply and demand zones. And more importantly, think about the action of what has happened or where have these supply and demand zones actually formed. All right, well, let's take a look at the live market together now, and more importantly, understand some of the things that have happened recently in the market. And I'd like to take it over to also some questions if you have some. So I'll be reading the chat now as well. So if you have any questions, feel free to ask them, and we'll answer those as much as we can. It looks like here we've got a few questions coming down here. Will Gabba says range bound is a gift. Well, that's a good comment there because, yes, you're absolutely correct. Range bound markets are a little bit of a gift. And the reason why it's a gift is because it's giving you excellent structure or excellent market action in the future. So don't think of a boring market as boring so much. Instead, think of it as, oh, now I get to set my alerts. That's a great comment there. David says, when I want to trade 5-minute break and retest, which time frame am I trying to engage on? Is it the daily or hourly levels? I think you can start on something like a day. And then what you could do is you could break it down into the 2 hour, 1 hour. And then once you get your level, you'll be able to then scrape it down to the 5 minutes. So for an example here, let's use the US 500 from the previous week. You might notice we have a drop. We have some kind of base here. Okay. So here we get a base. Now let's have a look at this base. So we have kind of like a 1, 1, 2, 2, and it sits around this level. And then it breaks pretty strongly down. There's the break. Okay. What that tells us is the market is bearish. All right. That's just quite simple. The market's bearish, and this is therefore a supply. So now that we know that's a supply, what could we do? Well, if the market then came back up into that level, what would we be potentially looking at doing? Maybe looking at sell. Is the overall trend down on the higher timeframes? That would be a question you'd ask yourself. In this case, it looks like it's making it lower lows, lower peaks, lower lows, etc. So it's good case that in here on your 5-minute chart that you had a question about, or your 10-minute chart, or your even 3-minute chart, that as it comes into that range, you could be thinking, I have a little bit of a bearish bias now, but I'm looking for my systems to activate. Now, whether that's a system based on your scalping and indicators that you might use, RSI or MACD or moving averages or price action or anything like that, then it would basically be a very, very good level for you to potentially be looking at. Now, over here on the right-hand side, you can see again, it reacts to that zone. You might think, oh, cool, that's another opportunity. Yeah, it was another opportunity. But what you're always doing is remember, it's about stacking the evidence in your favor. Is this a level of supply? Yes. Did we see a reaction off it already over here? Yes. Will we always see it act as supply? No, not necessarily. So each time it comes up to this zone, you can't just say, oh, I'm going to sell. You want to use smaller time frames to confirm those sells. Okay. And that's really the essence of supply and demand. It finds zones, it finds areas where you know positions were in. So therefore, you can potentially apply that to the future as well. That's a great question there. We've got another one here. For example, daily is bearish, hourly is bullish. Which trend is more important as a day trader? Generally, the daily will still be the most important, but it's about understanding the multi-time frames. So what you're doing is you're saying, okay, in this case, let's say you would have the hourly being potentially bullish, but the daily would be down, and the structure of the supply and the demand zone was telling you to be bearish at this point here. So therefore, we would pay attention to the 2-hour, 4-hour daily structure. We would pay attention to the fact that it's in the zone, and then we would be looking for the short in this case. Hopefully that makes sense. Dan Lanny says the break of structure after the zone shows it has power to be bullish now. Minor structure anyway. Now I'm not sure which particular pair you're talking about here, but I assume you're talking about what we've got here on the chart, which is the US 500. So what we've done so far is you're correct. we've broken through the supply. Now, what does that tell us? Well, it tells us that there's maybe a good chance the market will want to move to the next level of equilibrium. So that means it's moving to the next level that maybe the market will find some harmony at. Now, what do we know? Well, we know the last level at the moment was 44.40. Now, does that mean it needs to go all the way up there first? And you're like, do. Not necessarily. Of course, it could drop back first. Now, if it drops back first, what are you going to be doing? Looking at the previous levels of demand. And you can structure in on the smaller time frames and say, well, if I saw a reaction off here, if I saw a reaction off here, obviously just example areas that you could be looking at, what would I then look to do? Well, I can understand the storyline and then say, well, at this stage, it's broken to the upside. So therefore, we might be moving towards 44.40. So if it comes back down, we could look for potentially longs. And it's just an example here on the charts. Again, it's just for educational purposes. You've got to take your own risks and all those types of things. But this is the type of thing that you'd be thinking about in markets. Remember, when a market becomes range bound, it is an opportunity for the future to know where large positions have been entered into the markets. We have a question coming in here. How many lots should we buy at a time? You should always risk the correct amount for your account. So, in example, some people say that could be about 1% of whatever your trade balance is. Some people say it's 0.5% of the risk of your account. Some people would even say it's lower. What I generally would say is you want to trade very, very small risk to start off with, and you want to get what we call the replications in. It's not a sprint, it's a marathon when it comes to trading. So generally you want to get the reps in, and that means that ideally you would get around 40 replications of your same trade and go from there. Risking lots at the start, usually not a great idea. I'm sure a few people in the chat could maybe tell you about that one though, if you'd like there. This validates demand zones below its previous break of structure. Beautiful gap to fill where you've marked out. Well, I mean, yeah, there's some gaps in certain areas here, but yeah, exactly. You can use gaps along with that. For execution, for capturing the daily range, like most of the ATR, whoops, this is somebody, I guess, thinking about what they like to use. Most of the ATR, and I can't read the comment here. Execution for capturing the daily range, like most of the ATR for the day, which is the better execution than the 5 minute? Oh, I'm not sure what you mean by that question. 1 minute or 5 minute. Oh, okay, I would prefer 5 minute, 3 minute, 5 minute range. So basically, what's the best time frames? I think 1 minute is a little fast in this day and age. Now, that's not to say I didn't start in that time zone. I started even lower. I was trading tick ranges. So, yeah, look, you could say, could you do it? Yes. Is it more stressful? Maybe. Look, what you'll actually care about is less of the time zone and more of the way the market structures. As you build out your idea or your concepts of price action structure positioning, you'll actually notice that whether you're looking at a 10-minute, 15-minute, 12 minutes, 11-minute, or even 7-minute chart, it really won't make any difference to you, because while that might make a difference, let's say, to a candle formation that you're getting on those charts, it won't make a difference to price structure. So if I look at this 3-minute chart here, for example, it really makes no difference to where I'm looking at those demand zones. They are the exact same demand zones that I would draw on a higher time frame as well, and I'd be paying attention to that structure. So again, could I see that on 3-minute, 5-minute, 7-minute, 12-minute chart? Absolutely, I could. That's the beauty of supply and demand and understanding where positioning is when it comes to these markets. Eric says, what is the most traded level in your chart? My most traded level, or the most traded level of the market overall? They are different things. If you want to, the most traded level here, sorry, is what you're talking about. Yeah, so that's the most traded level of the market. Okay, so that's just an example of something I'm using a strategy that we've talked about before on these Pepperstone videos, and basically this is the most traded level of the last 2 years. So if you were to say, where have the biggest positions gone in general, it's this level. But that doesn't mean you're instantly going to get a reaction off those zones. It just means that's the biggest trade volume. So it's something you can take into consideration when you're considering everything to do with stacking confluence. Yeah. Okay, I get what you're saying there. How do you integrate the session info like London into your analysis for a pound US dollar? So I guess when you're saying session info, I'm not too sure what you mean there, Eric, in terms of session info, but I'm assuming it's got to do with, are you talking about news, or are you discussing structure building up into the London Open, or are you discussing like session as in the previous session of London and how do you integrate that into New York or something? These I'm not exactly sure what you mean. I'll give an example though for how would we look at maybe a pre-market. So oftentimes people consider when you're using some type of breakout strategy that you've got about 1 hour before. So let's say when Europe opens, which is Frankfurt Open, you've got 1 hour before London traditionally. And around that time, you'll start to see liquidity injecting. So effectively, that will be when you get that liquidity injection into the markets. And it's a pretty exciting time for markets. Now, if you had a build-up structure from the close of, so let's say you're trading pound USD, close of New York, and then you had like kind of a market that was doing this, and then you had a market that broke out in one direction, let's say into London. What I would then say is I'd say, well, if the market comes back into that area, because we now know that the positions that were placed there were supply, that could be an interesting sell zone. So that's what I'd be looking at it. Now, in terms of, is it more volatility? Yeah, I mean, there's always going to be more volatility into Europe, into London, into New York for the time being on most pairs. Obviously, there are some that trade into Asia, but that would be the type of thing I'd be looking at. And often you'll see breaks happen into the liquidity events. So that means a lot of people come in around 30 minutes before the market open. And usually you see these types of breaks about 1.5 to 2 hours after the market open has occurred. Do you only use the 20 SMA or EMA? I like both, but generally we would use the 20 EMA just because the EMA gives greater weighting onto the most recent price action, and because it's a relatively low period usage, then we would say 20 would be the good one. Dan says, in your opinion, what is the strongest confluence to use with supply and demand other than following the trend? Many other ones. I would use. I mean, I've written a course obviously on it, but over on fxevolution.com. But basically, I would use volume tools for sure, and then I would also use the mixture of fibs on them as well. And then there's a whole bunch of different VWAPs and stuff that you can use as well. So it's a mixture of those confluence techniques. Also understanding even support resistance onto it is really good, and then even psychological numbers as well. And candle formations. I mean, all of these things can help, and they create pretty good stuff here. Do you also look at the volume before executing trade? Not necessarily. I will use volume techniques, but I don't necessarily need to look at volume. Depends on what pair you're looking at as well. So US 500 indices, they might have different volume spiking. So you can see here on the Pepperstone platform, we've got some nice volume here around these lows. So that might tell you the demand is fairly strong, or at least there's a lot of transactions going on there. So when you're then paying attention to these candle wicks, you might say, oh, they look strong. That's pretty cool. Anyway, guys, look, I hope everybody has enjoyed today's session. Obviously, supply and demand, two big learning things there, the 1-1 and the 2-2. And then, of course, on top of that, we've also gone over some key stuff to do with understanding the storyline. So thinking about those candle formations a little bit more and where they're at. It's not usually taught in the books out there. It's not taught by most people, at least in my opinion. And I think that's something that, is a really big difference and can help you as traders and investors in the market. So if you did find it pretty helpful, give it a thumbs up. We really appreciate that. Do remember, now that we're back, we'll be on every Wednesday. So pay attention, when Wednesday at 8 p.m. AEST. And next time as well, Tyrone will be on the show. Unfortunately, he wasn't able to make it, but he says hello to each and every one of you out there today. And we really appreciate Pepperstone for allowing us to put this on. We've got some great topics coming at you, and this is good. So Dan says, thanks very much. A very interesting topic in modern day trading strategies. Yeah, look, the original trading strategies were obviously a little bit different. You'd be looking at more tape reads and stuff, but really, actually, not much has changed. It's just the tools that we have to visualize and see positioning have become a lot stronger. So remember, it's not about making things complicated in trading, it's about making them simplified, but at the same time, it's about being really logical. It's like anything. You hear stuff all the time. And you think, well, oh, that sounds amazing, but does it make any sense? So always ask yourself the question: do you believe that Wall Street and larger position traders or larger traders actually position into the market at different prices? If that's something you believe is true, then of course it may make sense. And when you see sideways market reactions or markets going into sideways, that doesn't necessarily mean there is no trade going on. It just means there is no catalyst necessarily to break it to the next level. When it does break out, that's why you often get those strong moves. But it's really more about the reaction past that point that you need to think about. You got to go a few steps ahead, which I think is key there. Do you have vid playback? I came in late. Absolutely, Chad. You can watch it straight away. So thank you very much, guys. Much appreciated. We'll see you next time.